good. Good afternoon, everyone. Great to see you all again, and be back in the hot seat before Glyn's roundup of market events. Thank you, Richard and Sanisha, for your presentations and everyone else. I am going to focus a little bit on bringing together some of the ideas and manager strategies that you've heard about over the last day and a half into the multi-asset construct and how we think about putting or how we do put portfolios together. Obviously, we operate in a few different jurisdictions within the UK, South Africa, and the offshore markets as well. So it's never quite a one-size-fits-all, but I often sort of talk about a sort of universal chassis that underpins our investment process that Sanisha, Richard, and others have spoken about. So we build our individual portfolios and solutions around that and bespokeify them effectively for the different markets and risk profiles. So I thought I'd just start with, we don't do 60-40 investing, but it's a good way to look at the range of outcomes and how markets have behaved. I dragged this one out from one of my archives a couple of years ago, but looking almost over 50 years back to 1977, it's global equities and US Treasuries, which I proxy maybe for global bonds, but it's just showing that the average return has been 8% actually, but the dispersion of those has been very wide. 2022 is very close in our memory. That was a really challenging year for 60-40, and for all assets, pretty much all asset classes actually. There were just very few that did well there. Gold was probably one of them, and we'll talk more about that. But then last year we had a bit of a reversion, maybe not as much as one might have expected after such a tough 2022, and it was only really in the last 3 months of the year when the rate narrative shifted quite meaningfully that we had this pickup. And then year to date, steady as she goes, a bit above average, if you like. That will have hopefully a bit of a further impetus with the change in the policy rates that we've had overnight in the US, and the no change that we've had actually in the UK today, about 20 minutes ago. What I've done, just this blue line here, is a sort of retrofitted. I've used the Harmony US dollar balanced fund as a sort of representative, if you like, of a sort of multi-asset. I've taken just the asset allocation of that at the end of August and then just plotted it back to see, how that shapes up. So you can see in that allocation alone, that's not with active managers or fees or etc., but we chart a similar kind of path. And you can just see what a tough year 2022 was. I mean, it's the only point in that quadrant for the last nearly 50 years where global equities and bonds both were down. And usually, interestingly, we're talking about sort of correlation and diversification, but within global equities and global bonds, usually you're sort of in that top right-hand quadrant of reasonable mid double-digit returns in equities and sort of low single digits for bonds. And we're sort of sitting in that range today. But the point is that the dispersion is very wide. And, the mindset and the approach you take and the investment horizon is very important when framing your investment decisions and the outcomes that you want to achieve. If you look at the rolling 1 year or 12-month return on a 60-40 portfolio, the range there, it's 50 percentage points variation between the best 12-month period and the worst. But as you extend your horizon, so that funnel narrows, as you can see. And actually, once you get to sort of 5 years and beyond, even the worst sort of 5-year annualized return is in positive territory. And then the average there is sort of high single digits. But your expectation, if you take that longer horizon and don't check the portfolio every day, but check in on a less frequent basis, the outcome it's very achievable, and you have a better investment journey. I'm going to look a little bit at just the shape of the market and some of the challenges that we face in building multi-asset portfolios today. Passive investment strategies have, been, as we know, growing in popularity. I think this is US assets. This is from Morningstar. It's US long-term fund assets. So I think this is probably bonds and equities. I think equities probably broke through the sort of 50% mark a year or two ago, probably, and it's probably further north than that. But sort of by definition, I guess, and it feeds itself. When you put today $1 into US long-term assets, 51 cents or more will be going just naively into following the market cap weighted index. It's not discriminating for return on equity or capital efficiency or debt or any of those things. It just goes where it's gone before, and that creates opportunities ultimately for the active manager cohort that is left behind. Many managers have either left or there's been a lot of consolidation within the industry as well, as this dynamic has played out. But by definition, as that goes up, the market is less efficient at allocating capital, and it should, make for a richer opportunity set for active managers. Just on a yearly basis, you can see the flows there consistently in positive territory for passive, and generally, negative for active strategies. But over the last 3 years, reassuring maybe to see that the rate of flow is stemming a little bit. And as we move into, again, a shift in the monetary policy cycle within developed markets, and divergence cycle as well, because we've got increasing rates in Japan. It will be interesting to see what comes out of their discussions at the end of this week. Nonetheless, the trend is there, and that means that the big get bigger. And this chart from Schroders just shows that back to when are we going back to 1980, and it's to November 23, and since then, it's a couple of points higher still. I think the top 10 names in the S&P, in the ETF at least, were about 34%. So where it goes next, we don't know, but we've already seen a bit of a shakeout in the last couple of months around that, and there is some cyclicality to this in terms of the dominance of those big names. SPW is the equal weighted S&P index. SPX is the market weighted, and it goes through different regimes. And certainly for the last 15, 20 years, when the line is going down, then the market weight is outperforming equal weight. But when it goes up, equal weight outperforms. And actually over the long term, it is the equal weight that actually wins out. But you get these strong reversions, as we saw after the tech bust in 1999, peaking out at 10% difference there. That's 5-year rolling returns as well. So cumulatively, and that should say annualized. Cumulatively, that's like 50 percentage points difference. So it's significant and a big opportunity for the active managers. Again, it leads to these burgeoning and swelling asset classes. You look at the IT sector, which is twice as big as the next biggest. This is the sector weights at the end of August, and if you look at the performance between 10th of July, we had this data point. I think it was on the 11th actually, where inflation just ticked a little bit lower than was expected. It's tiny, these misses are small, but they have very profound effects. It was expected to be 0.1 month on month, and it was minus 0.1. So this dovish shift took hold, and suddenly you had this huge outperformance of, well, not just actually the sort of utilities and the bond proxies, if you like, versus tech, but it was also the outperformance of small cap versus large cap as well. And I think within maybe 4 or 5 trading days, there was probably 15 percentage points difference between the small caps and the large caps. So can this period last for these big names? it can certainly persist, and it is at the moment, it's quite a force to be reckoned with, and you can say that the dynamics today are very different from 100 years ago, the network effects of technology and the like. But this chart from Bridgewater Associates, which I like, and it shows it quite well. What they've done is they've taken the 10 biggest US companies at the start of each decade, going back 120 years, and then at the start of the next decade, how big is their market share? So it's indexed to 100 at the beginning. And yeah, certainly, in a few circumstances, you had the railroads in the sort of 30s, and then you had energy names coming through later. And then obviously we've got a tech cohort at the moment as well. So some of them do persist and some of them do get larger, but eventually they have ultimately sort of faded as new entrants come to the market. They disrupt these big names, they get over-regulated, etc. And there's a fade on it. Another way to look at it, same team, different chart, again, is looking at the growth of those cohorts through time, and the average is the dark grey line there, and where we are currently is the blue. So like really peaking out, but if history is anything to go by, and it's no indicator of the future, then they will come under increasing pressure. And certainly we know that from the expectations that are already built into some of the earnings in some of these names. I read an anecdote, which I haven't fact-checked, I did read it the other day, that, if the Magnificent Seven continued growing at the same rate they have for the next 10 years they have for the last 10, they would collectively be the same as annual global GDP today. Which seems staggering, really. So, yes, it's possible, but there's a lot in the price already. So, why am I telling you this, and why am I sort of heavy on the concentration, maybe on the equity side? Well, Lorenzo mentioned the word, blend is your friend. We've long been advocates of bringing together, high conviction, discretionary, active strategies that themselves might have, they certainly have a sort of persistent outperformance. They're exploiting these, sort of human tendencies and biases, and they do have an outperformance profile over time, but equally they are quite volatile in their own right. So if we look at, these are just using the MSCI World indexes for 3 different styles. So we've got enhanced value, which you see there, world momentum, which call it a proxy for growth, and world quality as well. And the axis on the left, that's actually outperformance versus global equities, so it's not absolute performance. So each of these styles over time has shown persistent outperformance, but each of them individually is quite volatile, and you've seen that a lot in the last couple of years. Looks quite small on the chart, but there's 30, 40, 50 50 percentage points, sometimes performance between them. And so aligning yourself to one particular style like growth, it can pay returns for sure, but when it flips, it will flip very quickly. What you can do is bring all of that together and invest in, this is just a naive 1/3 portfolio of each of those styles, and you retain the alpha over time, you retain the outperformance, but you have a much better journey. You can do the same thing with a drawdown as well. Value remains in a drawdown. We all know what a challenging period it has had. But, we've had these post-COVID, we had that sort of kick up. And we've had other managers over the last day or two, demonstrate to us that there is a lot of opportunity and cheapness there to exploit. So again, you can see here the drawdown profile of the blended 3, much more preferable. And interesting as well, just to note, we were talking about value yesterday, and Dave Merklin from Lyrical said to us, there's the MSCI value index as well, which is full of cheap stocks, but they're not necessarily the ones that got the highest earnings potential as well. And these are the indexes that I'm using here. So When you substitute that with active managers, then you can improve the opportunity set and the return profile still further. I'll just try and show this here. This is one of Lorenzo's slides. Thank you very much. We've got a collection of managers on the right-hand side. This is sort of stylistic and representative, albeit the maths holds, but what you've got is 10 managers on the right-hand side, each of them outperforming over time with 3 to 4, 5% of active risk. Blending them together, you can see that improves the information ratio of 0.7 is the best 3 blended together, equally weighted. And then if you blend all 10, then you reduce the return a bit, but you get a superior information ratio. So blending together those styles and then blending together the managers, adding these different layers, ultimately is what we're trying to do when we put together these solutions to, keep the outcome in mind, but improve the journey for the clients. But it's not just about the equity. It's not just about global equities or equity styles. There's a whole range of asset classes that we can and do invest in. And it's deeper than this, but I wanted to just demonstrate really. I mean, these are monthly returns going back a year pretty much to October. And, you can see I've highlighted here global small caps. And, the order of dominance shifts a lot, particularly in the last few months. In June it was the worst asset class, and then in July it was the best one, and then in August it was sort of the worst again. So if you are trying to time in a big way on these asset classes or investment styles, ultimately you're going to get caught out. It's more about having that beta and the active manager selection in your construct over time, and then tilting it probably with the valuation opportunity. That's going to improve your return. Because if you eyeball that, then you might say, well, they kind of came out average overall and maybe there wasn't much return there. But over the last year, global small caps are up 30%. And if you got those decisions wrong, then you'd be down a magnitude more than that. Annual returns, we do the same thing. Just looking at this patchwork, obviously green are positive returns, red are negative. And as you'd probably expect to find, actually, so small caps should pay you a risk premium over time, being generally riskier investments. So you do see them sit actually sort of above in the sort of top cohort there. But again, the order of dominance changes. 2018 was a very tough year. 2022 was tough. What you're better doing is having an exposure to these stocks through a manager in your portfolio, like Granahan or Paradise, as we have in the Global Equity Fund, and pivoting around that allocation. Because when you've got it in your portfolio over time, over the last decade, they've given you 120% odd in terms of return. So it's a beta that you want to have in your portfolio. So again, what I've done here is just looked at the last 10 years for a 60-40 portfolio. And I sort of want to build on that and just show you how, we add in additional layers into the investment and portfolio construction that we do. Just broadening out the asset classes to include, real assets, alternatives, and cash. Yeah, there's a marginal increase. You can't really see it there. Going another layer still, breaking down the equities into the regional equities, real assets into property, infrastructure, and the like. You can see again a small sort of uptick. The scale's quite a big scale, but the drawdown is lower. The return is better. There's an improvement in the risk return there. And then for the last one, which I just sort of call this level 3 return, again similar to that first one, I've taken the asset allocation today of the Harmony US Dollar Balance Fund, and then I've just kept that static and pushed it back through time. So it's not representative necessarily of what the fund has done. But what I want to demonstrate is that by adding, increasing layers of asset class granularity and accessing different betas and styles and regions, you can meaningfully improve the risk return of your portfolio. There is, I guess, a risk or a perception that, you over-diversify portfolios a little bit. I think it's important to, just bring that back a step. Yes, we do have, quite a lot of holdings in the portfolios, but they might be serving. So some of these smaller positions will be serving just to sort of diversify the more sort of core asset class blocks that we've got in our portfolios. So again, if the sort of true sort of exposure, if you like, and the real value add, I would say, in the US dollar balance portfolio, looks a bit more like what you see on the screen up there today. Again, I'm talking about this Harmony portfolio, but we do the same in South African portfolios and the UK portfolios. It's a similar type of construct, and we share a lot of the names where we can. Sometimes the jurisdiction prevents us maybe from buying a particular manager in one region, but generally there's a big overlap, and first prize is always to have a manager that we bring in that we can put into all the portfolios. Briefly, this one's a little bit technical, but I thought it was worth sharing about correlation. We hear about implied volatility. You've heard about the VIX, this fear gauge on Wall Street. There's also, there are other indexes out there, and there's one which is the implied correlation index. Now, if all stocks in the S&P were perfectly correlated to each other, and they're all correlated at 1, there was no diversification benefit, then the value or the implied volatility of the VIX would merely be the sum of the weighted volatilities of the single stocks, because there's no diversification benefit. That's a 1-month index. This is a 3-month correlation index. It actually uses the 50 largest constituents of the S&P. And generally what it's saying is that when the line is low or falling, what it's saying is that there's more expected or lower implied correlation on a forward basis in the S&P index. And that means in order to have a lower implied volatility, you've got to have greater implied dispersion of returns within that. So I kind of think of this as a little bit of a proxy for the active manager opportunity set. There is an expectation that returns among the constituents are going to be different, and therefore active selection could be good, or certainly the opportunity is better for it. Win more by losing less. That is a very good mantra to work from. We produce some charts for the UK managed portfolios that we run, these sort of upside downside charts, and by having a lower drawdown perhaps than your competition or than the market, obviously that's a better outcome for your clients. I think when it comes to asset allocation, making investment decisions as well, it puts you on the front foot. It's much easier to to have a reactive allocation if you haven't fallen as much. So building in that diversification, I think is very, very helpful to enabling us to take progressive and effective asset allocation decisions. So the Harmony fund, again, so this is since 2012, which is pretty much around the launch time, versus global treasuries and the all world index. And we've actually made some changes to the strategic asset allocation in the portfolios recently. And in the balance fund, I would expect that from the modeling that we've done to take a good few percentage points off future drawdowns. No guarantees, but from the modeling that we've done, that is what we should sort of achieve. So it stacks up quite favorably to either of the big sort of 60-40 components. But then equally, if you sort of look at some of the other asset classes that are in there that are, thought to be diversifying and lower risk, they're not without risk themselves. Gold had a 40% drawdown, I think sort of around 2014, 2015 time, very drawn out over a longer period of time. So again, blending all that together into the fund, you get a superior. It's still painful, but it's better than any one of those individual asset classes that you can be in. And again, this is without any of the active manager selection. It's without the style blending that I've spoken about. Each of those which helps to reduce that. It's a similar chart. Just a quick couple of words of gold actually as well, because that is it's part of our portfolios. It's only a small weight today necessarily, but it has proven to be a very good diversifier. I think the gold price just bounced off $2,600 an ounce pretty much overnight and has sort of retraced and come back a little bit, but it's been punching new highs. And as Sanisha pointed out, there's a big demand for central banks, diversification of reserves, a lot of that coming from China, and that's pushed it up a lot. But if you compare, if you hold the gold price constant through time, since 1971, you have had this longer term sort of depreciation of the fiat currencies versus gold. And it wasn't just, sort of through the 70s, the end of the gold standard, but successive periods since we have seen weakness there as well. And that's actually a log scale, believe it or not. In January 1971, the gold price was around $40, and it's $2,600 today. So yes, it is a risk hedge, but it's also plays a role in portfolios preserving purchasing power through time. We want to, for us and for our clients, maintaining purchasing power is one thing. We want to grow it as well, but it plays a good role in portfolios for that. What about today? How does gold look? I think everyone has their own sort of views on gold and whether gold bugs, gold bears, etc. Many ways to look at it. I quite like the one versus real rates. I don't have that one in here. Maybe it's broken down a bit. One thing I do quite like to look at is the inflation adjusted gold price. So if you do adjust for inflation, then we are, probably in the top 1 or 2 percentiles over the last 50 plus years or so. But the momentum is with the gold price at the moment, and there's strong support from central bank buyers. So it doesn't in itself kind of mean anything, but it does either there's more inflation in the price, or more inflation expected to come through, or potentially dollar weakness because this is in gold. But if you take the average, maybe averages just for the sake of argument at about 500. Then over the next 10 years, you'd need around sort of 3%. If the gold price stayed the same, you'd need around 3% inflation per year for the next decade to bring the inflation-adjusted gold price back to around sort of 500 level. So yeah, it's quite interesting, just sort of framing it in that way. And thinking about equities, you can just go into Bloomberg and look at what the S&P index price is in gold. Then it doesn't actually look so expensive, does it, on the S&P side of things? That's something that Mark Baribeau said yesterday. It was quite an interesting chart I saw when he looked at excuse me, the tech cohort within the S&P, and I think it was trading, he said, about 1.5 times the value of the broader market, and that had peaked out at about 6 times in the TMT bubble of 2000. So that kind of corroborates actually what he was saying there. So again, in gold terms, the S&P may not look, quite so rich, or the gold price is a bit too high. So, you can make that for yourself. I called this presentation a portfolio for all seasons. So I thought, again, the Bloomberg there, I'll look at the seasonality function, put my sales hat on a little bit. We all know that September is a tough month historically in markets. In the S&P at least is down a little bit month to date. It was down a lot more, but it's recovered some ground. Anyway, I thought I'd look at quarterly returns because we're just a week or two off from the end of the third quarter, and the fourth quarter is typically pretty rosy for risk assets, for the Harmony Fund. Bonds, a bit more mixed through the year. There's obviously a lot of events going on over the next couple of months, not least the US election. So, however, the last time so the last time we had a Republican candidate win there, it actually turned out to be quite good for markets. But at the moment, as we know, something of a coin toss, maybe a slightly weighted coin in that at the moment. But actually, if you break that down on a yearly basis, it's just really actually 2018, which was the really tough one. And this is the Harmony portfolio. Again, this is Harmony US dollar growth. But generally, it's not a bad quarter. So I wouldn't advocate making your decisions necessarily around that, but it hasn't been bad historically. I was pretty much, this one I wanted to show because it's important. We've spoken about this mini rotation that happened in July, and we've spoken as well about some of the changes that, and Lorenzo has spoken about, some of the changes that we put into the portfolios, which also includes, starting to embed M.M into portfolios. We've got these little dotted lines on the charts, and that first one on the left-hand side was when we had that inflation miss. And we had a big outperformance of small caps versus large caps, and defensives versus the big tech. And that sort of paved the way, I think, for a good period of performance for our funds. Again, this is a very short-term view, but I thought worth showing just how when you do get these rotations and you do get a disruption from the norm and a wedge underneath the sort of the passive strategies and the beast that has grown so big, then these opportunities do emerge, and it plays very well to the portfolios that we put together and construct. So just running that through to, I can't remember quite when that was, probably the end of last week or so, just against a few of the funds that we compete with in that market. Nice to see that sort of a couple of points ahead. The second dotted line was when we probably, I wouldn't say finished, but we were evolving the portfolios and the asset allocation. So that was quite a big shift that we did out of real assets, listed property and infrastructure into global equities. And that had diverged probably sort of 10% or so since June. So we'd waited on that because the performance of global equities versus those had been so extreme. We didn't think it was the best time to pull the trigger, but we did that, and then have enjoyed the ride since. Finally, I just draw attention to our asset allocation dashboard, which we have in our, I think that goes out in the Viewpoint and quarterly reports. It's in there. It's very useful. It's a good place to look at the views, the collective views of the team, which we debate at our asset allocation meetings. It's quite high level. You don't get the level of granularity to the different styles or the different sort of duration tenors, etc. All the credit and the different opportunities that are presented in say, some of the more specialist markets like private equity, property, infrastructure trusts, etc. Nonetheless, that is there. It's in the pack. I'll draw your attention to it because it's a good piece and represents, as I say, the sort of best investment views of the team at the time. So I will wrap up there. I'm a little bit over. Happy to take any questions if we have any now. And yeah, thank you.